My goodness, how the mighty have fallen. What's up, guys? Welcome back to Investing Sucks. And today we're going to be taking a look at what was once one of the most highly respected and highly regarded financial institutions in all of Canada, and that is Brookfield. Specifically, we're going to be looking at one of their flagship funds, Brookfield Infrastructure Partners. So recently, this has seen a pretty massive decline pretty much over the past year. As we look here in the past year, it's down about 26%, which is pretty uncharacteristic for a partnership of this size and one that is set up the way this one is. And it was driven by, of all things, poor accounting practices, which at the surface seem to be masking very poor and deteriorating underlying performance in this specific fund. So what I want to do in this video is I want to use this and take this opportunity to remind you guys, or really just show you guys, how you can go about spotting odd accounting practices and essentially when to know when your BS radar needs to start going off. And I also want to use this as a reminder to all the investors out there that do end up taking the time to watch this video that really when it comes to anything in investing, if you can't understand it fully, it's probably best to just not invest in it. So this recent decline that we have seen in Brookfield Infrastructure Partners, really this was catalyzed by one macro level force and then another micro level force that is specific to Brookfield. And that macro force is the tightening of monetary policy. And really with this, there's one chart that I can pull up that is going to summarize this whole phenomenon pretty well. So what we're going to look at is the yield on a 10-year US Treasury bond. So this is essentially your risk-free rate, right? These are US Treasuries. There's pretty much no risk inherent in investing in these. And we're going to compare this to the dividend yield on Brookfield Infrastructure Partners, which obviously that dividend yield is a big reason why you're investing in this thing in the first place because it offers a pretty high yield. So if we go back to the years before, pretty much before 2020, there was a pretty meaningful difference between these two, right? In the purple, we have Brookfield Infrastructure Partners, and it's the yield on this is significantly higher versus the 10-year Treasury bond. So you're compensated for taking on the additional risk of investing in something that, does have risk associated, right? It's not a guaranteed return. But then over the years, this return starts to converge and converge until it gets to a point where the treasury yield is actually higher, which is kind of where we're at today. I mean, today it's roughly equal, the two. So when you see that, you kind of think as an investor, okay, why would I invest in this yielding company when I can just invest in treasury bonds and get pretty much the same return without having to take on any risk? I mean, it is possible I might get a higher return on Brookfield if the value of each unit does go up, but it's also possible it goes down, right? So is it really worth the risk when interest rates are as high as they are now? A lot of investors are starting to think not. So that's kind of the macro level force that has been not just weighing down on Brookfield infrastructure, but really just any type of company like this in general, whether it's a REIT, utility company, a lot of them have been seeing this happening. Now, the more micro level force is what's going on with this short report that was released about a month ago. And this report essentially it alleges that through the use of various misleading accounting practices, Brookfield has been covering up an unsustainable business model in infrastructure partners specifically, and they cannot afford to keep paying the dividends that they're paying to investors. And they basically think that the shares are trading at a significant multiple to net asset value, which is completely unwarranted. There's no reason for that significant premium to exist. And then the downside they see is roughly 70%, which is obviously quite significant. Now, it's important to note if we go back to Brookfield here and we'll open up the details tab, which, by the way, if you're wondering about this website I'm using here, it's called tickernomics.com. This is a website that I created personally, and it has plenty of financial data on all kinds of companies around the world, stocks and everything. So if you are interested in using it, link is in the description. So with Brookfield, they are incorporated in Bermuda, right? So the disclosure requirements are a bit more lax there. But really what this fund is it's a holding company of infrastructure assets and various businesses all around the world. And how you would typically value a holding company is just the sum of the parts, right? The total value of their ownership share in all the infrastructure assets and all the businesses that they own, which is also called net asset value, right? That's the most clear-cut way of valuing this. And typically, holding companies will actually be worth less than their total net asset value because there's just so many different companies and different investors are going to have disagreements on the valuation of certain assets that's held within a holding company. So you're pretty much always going to see it valued a bit lower, right? So how do we actually know what the net asset value is for Brookfield Infrastructure Partners? Well, this is something we can look at in their disclosures. And there's this metric here, 9.2 billion partnership capital attributable to the partnership, right? So, okay, let's say we use this. And by the way, looking through this report, this is really the closest thing I could see to net asset value. So 9.2 billion, what's the current value or the market cap, I guess, of this partnership? It's about 12.6 billion. So you think, okay, that's about a 1.3, 1.4x multiple, right? That's not exorbitantly high. But the problem is, what exactly is this partnership capital here, right? This isn't necessarily net asset value, which would be much more useful. And unfortunately, net asset value isn't really disclosed anywhere in any of their filings. Nor do they make it easy for you to find out what it actually is because there's very limited disclosure around the actual businesses that they own in this partnership. And what we're going to see in this short report is the author basically had to individually go to all the filings of the portfolio companies from all around the world to even have a shot at estimating what an accurate net asset value is for Brookfield Infrastructure Partners. Specifically, if we go to page 4 here, he gives his estimate and he's basically saying, okay, net asset value on a per share basis, about $11.40. Now, what's the price of this partnership fund overall? Well, $23 as of this, it's now gone up to about $27. So you're looking at 120% or so premium to the net asset value, right? So why is that, right? That seems just way too high for a holding company. So to me, when I learned about this, I'm just kind of like, okay, if that's the case, then why has no one called this out before, right? I mean, their disclosures have been like this for a while, right? They've really been reporting kind of in these lax reporting standards, not really, following any sort of gap accounting and kind of presenting their own version of metrics to investors. So why is this just being called out now when this has been going on for 10 plus years? And what I think the answer seems to be, if we go to this page here, which is page 48, is for one, for a few years, they weren't actually trading at that high of a multiple to net asset value, right? As we can see for kind of 2010 to call it, 2015, the market cap was roughly in line with what the underlying net asset value was. And then kind of as we get into these future years here, we see it expand a bit, but also consider again, we're in a very low interest rate environment. So for a company that specifically is investing in infrastructure assets, I can kind of understand it, especially if the company has shown historically that they are pretty good at investing in these types of things. They do have a strong aptitude for it, then I can see why investors would be a little bit more optimistic about the future and value them a bit more high because there's reason to be excited, right? Because interest rates are low, it's very easy to raise financing, and you're going to use debt financing specifically when you're buying infrastructure assets. And you combine that with the fact that the partnership has been delivering very strong returns. I mean, pretty much since going back to 2010 here, they've actually outperformed the S&P 500 by about 2 or 3% overall. So you combine all those things and you kind of think, well, pretty much until now, there's been no reason to question this. Now we're in a very different macroeconomic environment where it makes sense to question this kind of thing. So the net asset value was the first issue. The next issue, which is arguably more important, was their disclosure of FFO or funds from operations. Now, FFO, it's used very commonly in companies like REITs or utilities companies and pretty much any entities out there that exist primarily to invest in fixed assets and own and operate those assets and earn returns from those assets and then distribute a large portion of those returns to their shareholders. Sometimes they're called yield cos, and FFO is a metric that pretty much all of them are going to use. Now, with Brookfield Infrastructure Partners, the way they were calculating and disclosing FFO was a little dicey, meaning it essentially inflated the partnership's ability to distribute cash. And as we can see in this paragraph here, they basically say investors that FFO is the most important metric to look at when you're assessing this partnership because that's the basis they use to determine how much cash they're going to distribute and essentially what your yield is in this partnership, which is a big part of how you get compensated as an owner of the partnership. And one particular company that was called out in the short report as being problematic was this company called BUUK. So this represented about 13% of the total partnership's net assets. So pretty significant, which means a lot of their FFO is going to be coming from this one entity specifically. I think it was the second largest in their entire portfolio. So BUUK, what they are is they're what's called a last mile utility company, meaning they connect the larger utilities companies that source and produce things like electricity, gas, etc. They connect them to actual properties, right? Like commercial properties, residential properties. And what was happening in the UK, because they are based out of the UK, is to encourage more companies to build these last mile connections. The larger utility companies started offering incentive payments to the last mile utility companies, essentially to help them fund the construction that was required to set up the whole network. So BUK, them being a last mile utility company, has a revenue source on their income statement, which is called something along the lines of customer contributions to CapEx. Customers being, these larger utility companies because they pay the last mile utility companies basically transportation fees to get their gas or electricity to the end consumer. So you can think of it where it's this thing where there's an income source, but then there's also an offsetting cash outflow. And that cash outflow would be the construction costs that get presented as CapEx on the cash flow statement, specifically in the investing activities section of the cash flow statement. So since this is a very niche, financial arrangement, there's no universally accepted way of accounting for it. But the method that BUUK chose seems to be purposefully chosen to inflate the FFO metric for Brookfield because Brookfield owns about 80% interest in BUUK. And the cash outflow from CapEx shows up in the investing activities section, which is actually excluded from the calculation of FFO, right? But of course, revenue from all sources, even if it's these incentive payments that they're receiving that are just designed to help with the construction costs, even those that they're receiving, it's included as part of revenue, which does get included in the FFO calculation. So that may be a little confusing. So what I did in Excel here was basically do a simplified example of this, right? And this is essentially what's happening. So the way I see it, there's two different ways you could account for it. There's the way that BUUK chose, which is arguably the faulty way. It's not necessarily illegal or anything. It's just, it was something that when you look at it, it's very clear and obvious why they chose this specific method. And then there's the alternative way, which is discussed in accounting standards, and it's possible other companies apply this method too. I haven't dug too deep into that. But let's say, you have BUK, they receive $200 million in revenue from these customer contributions to CapEx, which, as a reminder, also have an offsetting cash outflow, which appears in the investing activities section, which is essentially just CapEx, or a capital expenditure. And then they have 500 million in revenue from other sources like transportation fees. They have 250 million in this year of CapEx spending that's used for construction specifically. So basically, they're having 200 out of that 250 million funded by these customer contributions. And then let's say their depreciation and amortization for the year is 100 million, right? Just to keep things simple. So the way BUUK accounts for it, they would have 700 million in total revenue. Let's say their total expenses are 400 million, so their net income is showing as 300 million, right? And then when you're calculating FFO, for simplicity, let's just assume you're taking net income, you're just adding back depreciation, amortization. Remember, capital expenditures or, cash flow from investing activities, which we can assume is this negative 250 million because of, the CapEx construction spending. That's excluded from FFO. So FFO is 400 million under this method. The other way you could account for it is you basically take these customer contributions as a direct offset to capital expenditures. So capital expenditures, they feed into, the PP&E balance, property, plant, and equipment, which is, the construction of the whole utility network. So because they're receiving these contributions, another method you could use to account for it is basically you would just recognize 50 million in CapEx spending. So the 200 million or the 250 million CapEx spending minus the 200 million that you receive as customer contributions. So what would that look like, right? Well, it's not appearing in revenue anymore, right? So your revenue is only 500 million. The total expenses are still 400 million, but your net income is now 100 million. Your FFO, which is just the 100 million plus the 100 million in depreciation amortization, is now 200 million. So your FFO is now is basically half, right? It's 200 million lower, but your cash flow from investing activities is also lower, right? And it's now only negative 50 million instead of negative 250 million. So there's no actual impact to the economics of the business, right? In terms of, the free cash flow that's generating, free cash flow is the same in both scenarios. The only thing that's different is this FFO metric, which Brookfield obviously prioritizes quite a lot. So that's the key distinction with this accounting method. And like I said before, there seems to be no reason why they chose this method specifically, other than the fact that it has that, one effect of inflating FFO, which feeds into the disclosures that they have in Brookfield Infrastructure Partners, right? So of course, the problem is it inflates the FFO metric, which isn't great, but that's not really a huge deal if it weren't for the fact that the Brookfield Infrastructure Partners disclosures, which, is these files here, and then also these 20F forms, which is essentially their 10K, they don't really give that much entity level information that would allow a retail investor, if they were only reading Brookfield's disclosures, to actually understand that that was happening. There's no way that you would have known that's happening unless you actually dug super deep into this. If you're just taking Brookfield's disclosures at face value and assuming they have your best interest in heart, then you're not going to understand that's what's happening. And that's kind of the core problem that the short report comes up with many examples to call out, which is their disclosures are just not very good. They don't give you that much detailed information to understand how the partnership is actually making money and where the money is coming from to distribute to shareholders. And that's a pretty big issue, right? And it seems now it's finally caught up with them. And then going back to BU basically they're looking at, what their cash flows were in this chart here, the reported cash flows versus the adjusted cash flows, which are stripping out the effects of these customer contributions to CapEx. And it's significantly lower, right? In pretty much every year going back. So this is a big issue, right? And this kind of, it puts questions into investors' minds. If this is happening, I mean, what else is happening? Because this is just one of their largest holdings. They own many other infrastructure assets, and there's not very many disclosures on them. This could be happening in other areas, and that's pretty concerning and it raises doubts. Okay, so now the last thing I want to do is just give my overall thoughts on this whole Brookfield situation. And this isn't necessarily just for Brookfield Infrastructure Partners, but really this applies to all the specific Brookfield funds that are out there. I think they're just far too complex for the average retail investor to realistically be able to read them and actually understand what they do, how they make money, all the different investments they have and all across the globe, etc. Because me personally, guys, I was trying to actually look through some of these disclosures just to understand this partnership so I can include in this video my own valuation, what I think they're worth. But it was just too complicated for me to actually do that. And keep in mind, guys, I'm a CPA, right? And one thing that I used to do at the company that I currently work at is actually be responsible for reviewing some of the public disclosures that get sent out to investors for that company. And even with that experience under my belt, I still had a hard time understanding the accounting, all the disclosures, what it all meant, how to actually synthesize it and put that into a final valuation of this partnership to get an idea of what I think it's worth and what I think is a fair price. I couldn't even do that, right? So I don't think it's reasonable for your average retail investor out there to be able to do that. It just seems far too complex. And like I said many times throughout this video, if you can't understand it, then just don't invest in it. But despite that, obviously, a lot of people, not just retail investors, I mean, larger investors too, they have invested in these funds. And what I think has happened is Brookfield is very good at marketing them, right? The public perception around Brookfield has been quite positive for quite a while now. And these funds offered quite a good yield. And historically, like I said before, they were outperforming the market by 2 to 3% per year over pretty much 10 plus years, which is very, very good. So it makes sense that retail investors see that, they hear about that, and then they get enticed by that, and they want to take part in that potential upside and put a lot of faith in Brookfield because of this track record that they've developed, and just assume, without having to go through in depth in all the details of the disclosures and understand the accounting and all the investments, and just assume that Brookfield has your best interests at heart and they know what they're doing. They're good stewards of capital, as you would commonly hear it, and you can just invest in them and just park it there and you'll be good. But it seems now that's not necessarily the case, and it seems that trust that people have in them, at least a little bit, has now been violated. Because, like I said, if you can't understand the actual mechanics of the partnership, where it gets money from, how to calculate how much money is available to distribute to you as a unit holder of that partnership, then eventually you're going to get burned, right? Because if you can't understand it, you're going to make a mistake at some point. You're going to miscalculate something. You're not going to understand something properly. You're going to misinterpret something. You're going to miss something. I mean, something's going to happen, right? Whether it takes 15 years before something happens or it takes 3 months, eventually it's going to happen. So, moral of the story, and I know it's a very simple lesson that you hear all the time, but I think this video really, illustrates this point, is only invest in things that you actually can understand. Now, something I do think is reasonable for retail investors to understand is Brookfield Asset Management. So this is, I guess you could say it's part of the Brookfield ecosystem, but really it's different than the funds, and this actually makes money off of management fees for managing those specific funds. And that was another issue that the short report pointed out to, was how the management fees that Infrastructure Partners was paying to Brookfield Asset Management were growing significantly, and they weren't tied to the FFO metric, which they said was the most important metric. They were tied to the market cap of the partnership of Brookfield Infrastructure Partners. So that created this incentive for them to do what they could, present, favorable financial metrics, these non-GAAP financial metrics that inflate what investors' perception of the market cap should be, because that leads to, what their fees should be. And there's even a chart that was comparing net asset value to the fees that were paid, and it showed net asset value was flat for about a decade, whereas the fees were just going up and up every year. So that's another problem unto itself. But I do think with Brookfield Asset Management, this is more reasonable for retail investors to understand, because their fees that they earn are tied to AUM, right? Assets under management. And you can make pretty reasonable estimates about what assets under management will be. For example, you know that if interest rates go up and, debt instruments are now more attractive because they offer higher yields, Brookfield's assets under management as an alternative asset manager are going to go down, because people are going to remove their funds from there and put them into higher yielding debt instruments. And then the reverse happens if interest rates start to go down. That's a pretty easy assessment that I think a retail investor can reasonably make. So I think, I would say, if you're investing in Brookfield Asset Management, to me, that's okay, right? That's reasonable. But if you're looking at these specific funds, unless you have some very technical accounting knowledge and some very specific knowledge, personally, I can't really see a reason why you'd be doing that. But again, that's just my thoughts, right? Maybe that's not what you wanted to hear, but I just wanted to come on here and make an honest and candid video about what I think of the whole situation. So let me know what you guys think, and feel free to drop a comment on this video as well. I did actually purposely leave some things out of this video just because I'm curious to see if someone will raise a comment about that, and then I can talk about it in the comment section. But yeah, that pretty much does it for this video, guys. So thank you so much for sticking around and listening, and subscribe if you're new to my channel and you enjoy this type of content, and I will see you guys in the next video.